When you come to the United States as a highly skilled worker, you build a life here. You build a career, you earn equity, you save in retirement accounts, and over time you may build real wealth. But many people eventually plan to return home. Maybe you want to be closer to family, maybe you want to have a lower cost of living, or maybe you simply want to go back to where life had you before. What most people do not realize is that leaving the United States permanently comes with a tax consequence that can surprise even the most successful individuals. This is called the exit tax. The exit tax applies when someone gives up a long-term green card or renounces citizenship and their net worth is over $2 million. The government treats this as if you sold all your assets the day before you leave, even if you did not sell anything at all. The unrealized gains on those assets are added up and taxed as if they were sold. That is the core of the exit tax. For high earners who have accumulated equity compensation, real estate gains, or large brokerage accounts, that bill can be enormous if there is no planning in advance. There is an exemption that protects a portion of your gains. For 2025, the exclusion amount is approximately $800,000. This exemption amount is applied to the total amount of unrealized gains at the time you exit, which means only the gains above that amount are subject to the exit tax. But for many professionals in tech, finance, or medicine, the total unrealized gains still exceed the exemption by a wide margin. That is why planning early matters. At Rimac, we work with clients well before they decide to leave so they can structure their assets in a way that reduces or even eliminates their exposure to the exit tax. One strategy is to realize gains gradually over time while they are residents of a low-tax state. Another is to shift assets into vehicles that do not accumulate large unrealized gains by the time you leave. We also help clients evaluate what they plan to keep, what they plan to sell, and what should be moved into different structures before the exit tax rules lock into place. We also help clients model the different scenarios. What happens if you leave next year? What happens if you leave in 5 years? And what happens if you wait until certain stock awards vest? These models show the estimated exit tax under each scenario so clients can make intentional decisions rather than being surprised by a large tax bill when they're ready to move home. If you're a foreign professional living in the United States and you know you will return home one day, the best time to plan is long before you book that flight. This is complex, and every country interacts with the U.S. in a different way. At Rimac, we help clients understand their exposure, build a clear plan, and leave the United States without leaving behind a massive tax bill. If you want to explore how the exit tax could affect you and what steps you can take now, reach out and we can walk you through the process in a simple and balanced way.